September 18th, the Bank of England freezes rates at 4%. But this isn't just a pause, it's the moment the UK property market splits in two. London slipping, the north surging, and 1.6 million homeowners about to face £370 jumps in monthly bills. But who stands to lose and who's poised to win as the divide widens? It all starts right here. A single decision at Threadneedle Street and suddenly the ground shifts beneath more than 1 million UK households. The Bank of England's rate freeze at 4% wasn't just a technical move. It landed straight in the middle of family budgets. For anyone with a fixed rate mortgage set during the pandemic, the numbers are now impossible to ignore. A £250,000 loan that once cost £1,060 a month at 2% now demands £1,430 at 4%. That's £370 extra every month, or £4,440 over a year. Money that used to cover holidays, school trips, or the weekly shop. Across the country, kitchen tables have turned into war rooms. Budget spreadsheets get pulled up, every bill scrutinized, every subscription reconsidered. Financial counselors report families slashing spending, cancelling streaming services, and putting off home repairs. Some are offered new rates by their lenders, but there's little room to negotiate. For many, the options are stark: dig deeper, downsize, or risk falling behind. One London homeowner wrote in their diary, "Our fixed rate is up in December. The new payments, if we don't move, eat half our household budget. Every bill now gets checked twice." Sleepless nights and tense conversations are becoming routine. Behind the headlines, the reality is personal. 1.6 million households bracing for a payment shock that's already reshaping daily life. A single glance at the latest regional data reveals a property market running at two speeds. In the northeast, average house prices jumped 6.6% over the past year. No other region comes close. London, by contrast, slipped into reverse, posting a 0.3% annual decline. That's not just a slowdown, it's outright contraction at the top of the market. The gap is staggering. The average London home now stands at £561,587, while in the northeast it's just £163,684. That's more than a £397,000 difference for the same set of bricks and mortar. This split isn't just about headline prices. The Royal Institution of Chartered Surveyors reports sentiment in the southeast at -43%, a level that signals deep pessimism among agents and surveyors. East Anglia isn't far behind, and across much of the south, negative readings have become the norm. Meanwhile, northern cities like Liverpool and Newcastle are seeing brisk sales, shorter times on the market, and a steady influx of buyers priced out elsewhere. The numbers point to something systematic. Affordability, rental yields, and local economies are pulling the market apart. For every southern homeowner recalculating budgets, there's a northern landlord fielding a dozen tenant inquiries. The divide is now so wide that it's reshaping where capital flows, who can buy, and what kinds of opportunities are even possible. Landlord instructions have collapsed to -38%, according to the latest RICS survey. That means for every new property coming onto the rental market, nearly 2 are being pulled off. The reasons are clear: tighter regulation, higher taxes, and mortgage costs that no longer add up. But as traditional landlords retreat, a new wave of investors is stepping in. UK Finance reports 58,347 new buy-to-let mortgages approved in just the first quarter of the year, a 38.6% jump from last year. The action isn't in London or the southeast, it's in cities like Liverpool, where a £120,000 flat can rent for £800 a month. That's an 8% gross yield, nearly triple what's typical in the capital. Tenant demand is fierce. Properties go within days, and bidding wars for rentals are common. One northern investor sums it up: "We're seeing more southern money than ever. The numbers work here, that's all that matters." The capital is moving north, chasing opportunity where returns are real and supply is tight. Forecasts from the UK's top property analysts have been slashed. Savills now expects just 1% house price growth for 2025, down from their earlier 4% call. Knight Frank has cut its own forecast from 3.5% to 1%. Both firms cite the same reasons: persistent affordability pressures, the north-south divide, and the Bank of England's decision to hold rates at 4%. All eyes are now on November the 6th, the next Bank of England meeting. The outcome will set the tone for the rest of the year. Until then, sellers in the south need to price sharply and be ready for tough negotiations. Buyers in the north should act quickly. The window for strong yields and affordable deals is closing fast. Anyone with a fixed rate mortgage expiring soon should speak to a broker now, not later. The market is moving. Those who wait for certainty may find their best options already gone. On September the 18th, 2025, the Bank of England held rates at 4%, defying expectations and triggering the sharpest regional split in the UK property market in years. Halifax data showed house prices fell by 0.3% that month, but beneath the average, the Northeast surged 6.6%, while London fell 0.3%. Over 1.6 million homeowners now face fixed-rate expiries, with monthly payments set to rise by £370 on a typical £250,000 mortgage. In the same period, UK Finance confirmed a 38.6% jump in new buy-to-let mortgages, and RICS reported a record minus 38% balance for landlord instructions. Forecasts from Savills and Knight Frank have both been cut to just 1% growth for 2025. What remains unclear is how long the north-south divide will last, and what decisions the Bank of England will make at its next meeting on November 6th. The evidence is clear. The UK property market is no longer moving as one. The split is here, and every new policy or rate decision will define which side gains ground.